drop a like and do share. Leave your comments and do not forget to subscribe for more videos.
What's up, guys? This is Manoj Bhuptani. I welcome you all on behalf of the Edupedia world. It's been a fantastic morning outside, and I'm sure that you guys must be enjoying your life, your surroundings, your family, the kind of time you're spending with people around to the fullest. Like as usual, guys. Perfect. So, guys, in our last video presentation, we have been discussing a few of the relevant kind of questions which have been already asked in CA final examination in the previous attempts. In the forthcoming presentation also, I'll keep going on with the kind of questions in order to make you understand the kind of things which are usually asked in CA final examinations. Because theoretical part was considered basically just to ensure that you guys get the concepts really well. But as far as the questions which were being asked in CA final examinations are concerned, most likely you'll get to see practical question over there. You need to solve a problem. Okay. And in order to ensure that you guys don't seem to be confused during your examination time, I need to ensure that you guys get the complete understanding of what kind of questions are usually asked in CA final examinations. So this presentation will be solely dedicated to the practical problems, and the remaining two which will be coming soon with the forthcoming videos, those will be also the ones which will be solely dedicated towards solving the practical kind of problems which are asked in CA final attempts. So are we guys all set for the day? Perfect. I hope that you guys are revising your topics time and again, because that is something which is extremely important for you guys. So whatever things I'm teaching you up over here, all you need to do is just revise and retain the topics which I'm telling you up. Try to solve the kind of problems which I'm showing up you in these video presentations yourself, because that's going to be making you into a kind of a habit of solving the problems directly with your hand. So don't try to read the solution and go ahead with the same. Nope. In the examination time, you won't get a chance to just read the paper. So you need to remember that you need to solve the questions over there with your hand. So try to practice that thing right here, right from this moment, okay? That will really help you up in your future assignments and examinations. Perfect, guys. Let's mark the beginning of this wonderful presentation in which I've got so many kind of questions for you guys to entertain. Perfect. Fasten up your seatbelts. We're about to take off with the first question of the day, and that will be, this question was asked in CS final examination. Okay, it says evaluate the feasibility or otherwise of a project keeping in view the following data. Number one, the nominal rate of return has been provided to us as 14%. Number two, the expected rate of inflation over the life of that project has been provided to us as 7%. Apart from that, the question has provided us the cash flows which we'll be getting from the project. Presently, I'll have to make an outflow, that is rupees 10,000. In the years to come, I'll get 3,000 in year 1, 3,000 in year 2, 3,000 in year 3, and 3,000 in year 4. So I'll be getting the constant amount of 3,000 for the next 4 years. Once I'll be spending a cash outflow of 10,000 in the present year. I'm supposed to find out the real rate of return. First of all, I need to check whether I should go ahead with the project or not. And second, what will be my real rate of return? Okay. So without going into the solution, it's a very basic question which has been asked in CS final examination. Let's understand it here itself. Okay. And then solution will be a very simple task to form. Guys, in this particular question, we have been told that the nominal rate of return is 14% and 7% is the inflation. Okay, let's understand the first thing, which is the NPV. Okay, whether we should go ahead with the project or not, which is that technique which usually helps us in understanding that. The first and the foremost one is NPV. Okay, net present value. I'm supposed to pay out 10,000 from my pocket. Whether I'll be able to recover those 10,000 or not, I'll have to see that first of all. So what I'll do is I'll directly get this cash outflow of 10,000 rupees as the present one. So it will be multiplied by 1 because I'm spending it right away, right at this moment. Apart from that, I'll be multiplying 3,000 for the present value factor of the 4 years at the percentage of 14, because nominal rate of return is 14. I'll get to know whether I should go ahead with the project or not. If in case that's positive, definitely it's a yes, we can go ahead with the same. If the NPV comes out to be negative in that particular case, it's always prudent not to get indulged in any kind of project or business which provides you a negative NPV. Are we guys clear with that? Perfect. Now, talking into the real rate of return part. Okay, let me make you clear with this kind of concept. What it says, guys, let's suppose we are living in a nation where there is no inflation. Think about a nation. Though it's a very hypothetical kind of a question, equation actually, situation basically. So, let's suppose there is no inflation. Okay, then in that particular case, what will happen? Whatever I'll be receiving as my nominal rate of interest, that will be exactly same as my real rate of interest. Okay, why? Because there is no inflation. Wherever you get a chance, if in any kind of countries there is a certain point of amount is involved with a basic thing of inflation, okay, then what I'll have to do is I'll have to just multiply the same with the real rate of return and I'll get the nominal rate of return. Let's suppose my risk-free interest is 7%, okay, but because there is an inflation which is involved in my country, I'll be adding, let's say, 2% to it, okay, as my inflation. What I'll get is I'll simply multiply 1.07 with 1.02. I'll get the figure of nominal interest rate, okay, that usually banks provide us as far as our loans are concerned. Wherever you go to a bank, okay, ask the bank first of all, what is your real rate of interest? They'll always tell you it's 5%, 6%, 8%, 10%. But what these guys are going to charge you up, they're going to charge you up like for 10%, 12%, 15%, 18%. Why? Because the inflation is available in the concept, okay? So they need to ensure that the kind of revenue that they'll be generating for their banks, whether they'll be able to compensate it against the inflation index or not. We all know India is a nation where there is a growing economy. So wherever there is the real rate of interest, again, there is also the inflation. So we need to consider both of them in order to get to a figure which is the nominal rate of interest. This is entirely the topic of real rate of return, nominal rate of return, and inflation. I hope you guys got like, get clear kind of understanding how it should be taken about. So shall we proceed towards the solution? Let's go ahead with that. What it says is, let's go ahead with the implementation of the feasibility study, which I told you of. Let's see NPV. My initial cash outflow over here is 10,000 rupees. Okay. Against the same, I'll be receiving 3,000 rupees cash inflow for the next 4 years down the line. Okay. At 14% nominal interest. I'll be multiplying it with the present value interest factor annuity of 14% for the period of 4 years. I'll get to know that the NPV here is minus 1.1258 basically. So that's a negative NPV. So should I go ahead with the project? Absolutely not. Why? Because it's a negative NPV. So the project is just not feasible. It's not profitable for me to enter into this project. Now coming to the second part, which I told you, real rate of return will be equal to 1 plus nominal rate of return equal to 1 plus real rate of return multiplied by 1 plus inflation, where R is basically equal to real rate, N is equal to nominal rate, and I is equal to inflation. I'll get to know that the real rate of return here is 1.14 divided by 1.07, that is my inflation, minus 1. I'll get to know that the real rate of return is merely 6.54. Did you guys get to know over here itself? Guys, the real rate of return, the actual interest, which should have been, had it been there, had been no inflation in the economy, it's merely 6.54. But once the inflation gets attracted and we need to compensate against that as well, I need to ensure that I'm getting that much amount wherein I can compensate against for the inflation index as well. So I'm charging from the people 14%, though my real rate of return is merely 6.54. So I'm charging nominal one, that is 14% over here. This was entirely the concept of real rate of return. I hope you guys got the complete understanding with the same part. Shall we proceed further with the next question, guys? Let's go ahead with the next one. And that will be, this question was asked in CA final examination for November 2010. What it says, let's understand and dig it a dip further. So, a firm has projected following cash flows from a project under evaluation. It says, for the year 0, my cash outflow is going to be 70 lakh rupees. For the year 1, year 2, and year 3, I'll be able to recover an amount of 30 lakh, 40 lakh, and 30 lakh as my cash inflows. The given cash flows have been made at expected prices after recognizing inflation. So what does that mean? It simply means that the kind of interest rate that has been provided to us in the question is already the nominal one. Why? Because the prices have like already been adjusted after recognizing inflation. So the firm's cost of capital here is 10%. That's a nominal one. Apart from that, it has been provided to us that the expected annual rate of inflation is 5%. So we need to show how the viability of the project is needs to be evaluated in this particular question. So let's understand the question again, my kind of theory. Let's understand the question here itself before we move on to the solution part. So you guys must be thinking about this thing. Why I usually I'm into habit of making you understand the question on the question part itself. There's a very a good kind of feeling which is involved here. It's here itself, and it simply says, guys, once I'll show you the solution, it will be like very much easy for you guys to go and grasp the concept. Okay, but why I am basically doing this kind of stuff wherein I ask you to go ahead with the question while seeing the question itself. Okay, this part basically helps you up in brainstorming. Okay, you try your level best to brainstorm along with me so that before we move on to the solution, you already have an idea of how it will be done. That's how brainstorming is done. That's why I make you into a habit of doing the question right here itself while seeing the question. That's the only motive behind that. So first of all we need to do is just think about this thing, guys. I have been provided the nominal rate of interest. Okay, here itself. What I need to do is I just need to check out whether this project is profitable for me or not. What I should go ahead. Which kind of technique should I use? Think about it. It's a very first and a very foremost one. The most common one, the most precise one, the NPV. Okay, I have been provided the nominal rate of interest. What I'm gonna do with that is I'll take it as my present value interest rate factor. Okay, for my 70 lakh rupees, that's gonna be my year zero outflow. So it will be multiplied by simply 1. But as far as my other cash flows are concerned, 30 lakh, 40 lakh and 30 lakh, I'll be multiplying them with the respective years present value interest rate factor at the percentage of 14. Sorry, 10%. That is the cost of capital over here. That 10% against that. I'll get to know whether I should go ahead with the project or not. This is number one thing. Okay. Now it says, think about the viability of the project if in case the expected annual rate of inflation is 5%. What I'm going to do in this particular case is now think about a situation wherein I have provided a solution to you and I have given you this thing that the cash flows are 30, 40 and 30 for the next 3 years. But these are the ones which have been the nominal ones. Okay. These are the ones which against which the inflations have already been adjusted. The line itself says that the given cash flows are being made at an expected prices after recognizing inflation. Are these my real cash flows? Absolutely not. If I like already adjusted my inflation against them, these are my nominal cash flows. So what should be done in order to see whether this project is viable for me as far as the real cash flows are concerned or not? I'll simply subtract the kind of inflation amount which is being included in these 30, 40 and 30 and I'll get the real cash flows. And once I'll get the real cash flows, I'll multiply the same with the present value interest factor of the real rate of return, real interest rate, and not with the nominal one. And I'll get to know whether I should go ahead with the project as far as my real cash flows are concerned or not. And this is how this question will be solved. Are you guys clear with that? Cool. Let's go ahead with the solution now. Now you'll get the perfect understanding for that. And it says simply, NPV can be used by using the nominal rate of discount. That is the number one part. So what I did was I just multiplied my cash flows that are the nominal ones. These are my nominal cash flows because it already includes the inflation factor. So 30 lakh, 40 lakh and 30 lakh. I'll be multiplying the same with the present value interest factor of at the percentage of 10%. Okay, that is my cost of capital. That is my nominal rate of interest. So I'll be multiplying the same with the respective year's PVIF. I'll get the total present value of that particular year as 27.725%, 33.06%, 22.54% as the third year one. I'll get the total present value as 82.87. Out of the same, I'll deduct my cash outflow, my initial cash flow, that was 70 lakh rupees. I'll get a present value, net present value as 12.87, which is a positive one. So should I go ahead with the project? Absolutely, I should. Why? Because the project is profitable for me any day. Now, coming to the second approach, okay, which I just shared with you guys. What if I need to consider only the NPV using the real rate of interest, real rate of discount? Then what should I do in that particular case? First of all, I need to evaluate and compute my real discount rate, my real interest rate. So that will be again with the same kind of concept which I told you. I have already in my kitty nominal rate of interest, that is 10%. I already have the figure of inflation. So I can simply get the figure of real rate of return, real discount rate basically. So that will be simple. 1.10 divided by 1.05 minus my interest. So it's gonna be 0.0476%. So that will be 4.76. My nominal discount rate was 10%. My real discount rate is 4.76%. So now all I need to do is I just need to subtract my inflation amount, okay, which has been already adjusted with my cash flows. I need to first of all subtract that in order to get my real cash flows. The real rate of discount can only be applied to the real cash flows. Remember that, okay? So I need to subtract basically the inflation amount out of the same. So 30 was my nominal interest rate, nominal cash flows. Okay, out of the same, I'll deduct my inflation. So the deflated factor, which has been like showed at 0.05%, that comes out to be 0.952 for the first year, 0.907 for the second year, and 864 for the third year. I got the figures. That is the real cash flow as 28.56 for the first year, 36.28 for the second year, and 25.92 for the third year. I'll be multiplying the same with the present value IF at the percentage of 4.76, which is my real discount rate for each of the three respective years. And I'll get my total present value for the first year as 27.27. Again, that is same, which has been like showed to me in nominal rate of discount. Now you'll be thinking, guys, why is the picture exactly the same with that? You need to consider the fact that it's all about the mathematical accuracy. Okay, for one side you are discounting it at real discount rate, okay, and on the other hand you have already subtracted the kind of discount, the kind of inflation which was adjusted into that cash flow. You have already subtracted that inflated amount, okay. Now you have got real cash flows and you are multiplying the same with real discount rate. It's gonna provide you the exactly same kind of result that was shown in nominal rate of discount. Nominal included, number one, the inflated amount in present value IF, and it also included the inflated amount in cash flows. So once you'll be subtracting the inflated amounts and inflated percentage from both the things, you'll get the same figure which has been like showed under real rate of discount, which comes out to be again the net present value of 12.87 million rupees. Okay, so this is how this question is likely to be solved and how you should go ahead with the presentation. This is the finest presentation you can get, and invigilators, the person who is going to check your examination sheet, he or she basically likes the way you present it. Okay, it's all about the presentation, it's all about the technical knowledge that you have. You'll be like having n number of technical knowledge, but if in case you don't know how to present your answers, okay, in your examination, that's gonna be creating an obstacle for you anytime. Okay, so you need to understand it with proper kind of technical knowledge. You need to have those proper presentation skills as well in order to understand that you need to score good number of marks in your examination. So that's how it goes ahead. So are we guys thorough with this particular question? I hope I was able to make you clear with the kind of things and the concepts that you need to apply while solving a question like this in your examination. Remember and remember and remember, while using the real rate of discount, you need to bring the cash flows which are already having the inflated figures, you need to bring it down to the real cash flows. This is the only catch in this particular question, and wherein the student might make a skip. So you need to bring that out to the real cash flows while multiplying that with the real rate of discount. Nominal ones will be multiplied with the nominal rate of discount. Real cash flows will be multiplied with the real rate of discount. Remember that. Perfect, guys. Let's move ahead with the next question. And that will be, this question was again asked in CA final examination, and it says Ankit Limited is considering taking up a project X and project Y. They need to consider one, project X or project Y. Both the projects have same life. They require the initial equal investment of 80 lakh rupees and have almost same yield. An attempt has been made to use the probability theory to analyze the pattern of the cash flow from either of the project during the first year of operation. This pattern is likely to continue during the life of these projects. The results of analysis uh, are as follows. It says project X and project Y, they are like basically having an initial investment of 80 lakh rupees, and they are going to provide you the same kind of risk and rewards. Okay, basically the reward and not the risk. Okay, risk we need to calculate for sure. They are provided as the kind of cash flows that will be like able to recover, and these are the probable ones. Okay, so projects X basically says the cash flows of like 12 lakh rupees, 14 lakh, 16 lakh, 18 lakh, 20 lakh, and 80 lakh rupees. Okay, and the probability which has been like provided to us, 80 lakhs is the total one. Okay, probability which has been like provided to us is 10%, 20%, 40%, 20%, 10%. Okay, that comes to be finally the 100%. As far as the project Y is concerned, the cash flow which has been like estimated and are the probable ones that you'll be like receiving are 8 lakh, 12 lakh, 16 lakh, 20 lakh, and 24 lakh. Again, the cash flows are the same, which is the 80. Now, what is the probability that I'll be receiving the kind of these cash flows in project Y? That will be 10%, 25%, 30%, 25%, and 10%. Now, it says we are supposed to decide as to which project is riskier to be dropped by the company. Think about a situation wherein you need to analyze, first of all, that which project we should go ahead with. This is something which I have like showed to you. Now, what will you guys do? Think about it. My initial investment is 80 lakh rupees and I'll be getting almost the same kind of yield. That means my reward is probably the same in both the cases. Okay, I'll get the same amount of money, most likely. Okay, they have like provided to me these cash flows. Okay, which project should I go ahead with? First of all you need to do is just check what is the probable kind of most likely cash flow that you'll be able to receive. And as far as the probability distribution is concerned, without going ahead with the solution, you can simply go ahead while solving it here itself, and you can simply see that 16 lakh in both the cases is the kind of possible cash flows which is having the maximum probability of coming in. So if for project X it's 0.4%, and for 0.4, and basically for project Y it's 0.3, which is both the maximum in their respective cases. So most likely the mean that I'll get, the summation, if I'll talk about the most common mean that I'll get in this particular case, that will be 16 lakh rupees itself. Okay, so I am spending a amount of like 80 lakh rupees. I am having the same kind of yield, that is my effective interest rate, which is the same one in both the cases. And also the kind of amount that I'll be receiving from the projects, both the projects, is also be the same, that is 16 lakh each year. Now you are into a fix wherein we should go. Think about it. Think. And you'll get to know that now the only option to analyze this situation is merely on the grounds of risk. Okay, which project is more riskier as compared to the other one? Okay, and the one which is more riskier, we are going to drop that case, and that's how this will be solved. And how to take care of the risk? Simple, guys. Remember, there is a concept which is known as variance and standard deviation. So we'll be applying that mean variance over here, and we'll get to know the kind of two variance which I'll get from project X and project Y. The one which will be like providing me a higher amount of variance, I'll drop it up. Why? Because that will be a more riskier project. That's how we'll go ahead with the project and this solution. Let's go ahead with the same in order to make you understand now the things more clearly. And it simply says evaluation of the alternative proposals. Number one comes in expected cash flows of project X, that is 16 lakh that I told you of, and expected cash flow of project Y as again 16 lakh again that I told you of while seeing the question itself. Because why we can see that? Why? Because the maximum amount of possible probability distribution was laying onto these two figures itself. So most likely there was a chance that we'll get these figures itself over there. Now, coming to the core part that comes out to be the variance part. So if I'll talk about project X first of all, okay. So guys, if I'll talk in comparison with the expected cash flow, that is 16 lakh rupees, I'll have to sum it up one by one. So my cash flow for the first distribution is 12 lakh. So I'll be subtracting my 16 lakh out of the same. I'll get a figure of -4 in the first case. In the next case, it's gonna be 14 minus 16 because my probability distribution for 14 has to be taken care of in that particular case. So that will give me a figure of -2 lakh. Same goes with the third case, that is 16 minus 16, that will give me a net cash flow for 0 rupees. And then 18 minus 16, that is gonna provide me the cash flow of 2 lakh. And finally, 20 minus 16, that's gonna provide me a cash flow of 4 lakh rupees. Now what's gonna be done? So now I just need to square up all these figures. So 4 into 4, that's gonna be 16, 2 into 2, that's gonna be 4, 0 into 0 will definitely provide you a figure of 0. 2 into 2, that will provide you 4, and 4 into 4 will provide you again 16. So all you need to do is, once you'll get these figures, you need to multiply the same with their respective probability distribution of occurrence, which was 0.10, 0.20, 0.40, 0.20 and 0.10 in the case of project X. After multiplying the same, you will get the variance of the cash flows for the project X. That comes out to be 4.80. Same exercise needs to be repeated for project Y. In the case of project Y, the expected cash flow for the project Y was again rupees 16 lakh. Now I need to calculate the variance of the cash flows for project Y in the similar manner which I did for project X. So it's going to be 8, 12, 16, 20 and 24. These are my different probability distribution amounts. I'll subtract my 16 lakh, my expected cash flow from each one of them. I'll get the figure of -8 lakh, -4 lakh, 0, +4 lakh and +8 lakh in the respective 5 scenarios. I'll simply multiply them with their respective figures. That means 8 needs to be multiplied with the power 2. So it's going to provide you a figure of 64. 4 will be multiplied by 4. It will provide you a figure of 16. Then 0. Then again 16. That is 4 into 4. And 8 into 8. That's again 64. Now, similar exercise has to be repeated. That is, we just need to multiply the same with the probability distributions of project Y, which is 0.10, 0.25, 0.3, 0.25 and 0.1. Once you'll be multiplying them with the respective figures, you'll get the variance of the cash flows for project Y as 20.80. So, which is the project which is more riskier? Absolutely, that's none other than project Y. Why? Because the project Y's variance is much, much, much higher than the variance of cash flows for project X. So you'll be getting the same kind of reward in both the cases, that is 16 lakh. So which kind of project should you choose will depend on the one which provides you the lower standard deviation, the lower variance, the lower amount of risk, and that is none other than project X. So all you need to do is just go ahead completely relying with project X. And this was a question which was asked in CA final examination as well, and I hope I was able to deliver you the kind of quality with respect to this particular solution as well. So all you need to do is, guys, just remember whatever I'm teaching you up, you just need to grasp that up and try and do revise your concepts. Revise and retain them up till the time you see your actual question paper during your CA final examination. And I'm sure that one day you'll make us all proud. Perfect, guys. With this, I'll say thank you on behalf of the Edupedia world. Keep interacting with our questions, queries, and YouTube comment boxes. I will love to answer each one of your queries and grievances. If in case you have liked our video, if in case you find it informative, if in case you have loved it up, then do ensure that you guys do give us the thumbs up, and definitely don't forget to mention your comments, valuable comments that will help us in motivating ourselves in order to provide you the better services in future. Stay connected. That will. With this, I'll say Tada, bye bye, sayonara. I'll see you in the next presentation with a lot more fascinating questions. All of them are waiting for you to see them up. Perfect, guys. I'll see you in the next presentations. Till then, bye.